Welcome, Ron Chakler again with American Portfolios. Well, now it's April 2012, and we've just passed the 3-year anniversary of the bottom of the stock market. On March 9, 2009, the S&P hit 677 and has more than doubled since then. And we've just completed its best quarter in 14 years, which ended 3/31/12. But despite the strong performance of the stock market over the past 3 years, we're still seeing a tremendous amount of fear among investors. There's more money continuing to pour into bond funds over stock funds despite the record low interest rates. It is very important that investors understand the relationship between interest rates and bonds, and that they are aware of the interest rate risk when investing in bonds should rates begin to climb higher in the future. In this video, I'd like to address the topic of stock dividends. Remember, the total return of a stock is comprised of the dividend income and the capital appreciation combined. In markets where capital appreciation is limited or even absent, the dividend can provide a steady source of income. As you can see by this chart, dividends as a percentage of total return has varied through different time periods and market cycles. In the 1940s and 1970s, it represented more than 50% of the total monthly returns. However, in the capital appreciation intensive environment of the 1990s, dividends only accounted for just 14% of total returns. But on a cumulative basis, dividend income has contributed more than 1/3 of the total equity return to the S&P 500 index. So with interest rates at historical lows, I think an attractive opportunity exists today in the environment with regard to equity dividends. Statistics compiled by S&P indices have projected the 2012 dividend payout at $277 billion. That's up 15% from the record high that was set in 2008. Also, the total cash that's held by U.S. companies that make up the S&P 500 are also at a record $1 trillion as of the end of 2011. And the ratio of dividend payout to cash is about 30%. That's compared with the historic average of 52%. One more figure for you to consider. 3/4 of all the S&P 500 companies that are paying a dividend are making higher payouts than they did last year. This should be enough to fuel investors to consider looking at companies that have had a history of dividend increases. Let's look at some of them. This slide shows you some of the great American companies that have had a long history of rewarding shareholders with consistent dividend increases. One thing is clear. Dividends have proven to be a critical component to overall returns. The latest sign of a dividend renaissance is Apple's decision to begin to share some of their profits with shareholders for the first time in nearly 2 decades. We're also seeing at least 9 top banks considering raising their payouts after the government conducted stress tests to ensure that these banks can survive another crisis. One of the reasons investors are looking elsewhere for yield is this. If you've invested $10,000 in a money market account on December 31st, 2011, at the current rate for 1 year, you'd earn about $4, which is about the cost of a cup of coffee at Starbucks. A 1-year CD would provide you around $20, or about the cost of a night at the movies, and that's not even including the popcorn. 10-year treasuries would give you just about under $200, or about the cost of a trip to the grocery store. That is not a lot of return on your money. With the S&P dividend yield now close to that of the 10-year treasury bond. In addition, the earnings of the S&P 500 are also very close to that of the record levels seen in 2007. So companies that have a strong global footprint, good balance sheets, generate high free cash flow, and have a history of rewarding shareholders with dividend increases can offer investors a nice source of income that will most importantly keep up with inflation. Give me a call and see if we can see if that will fit into your portfolio. Thank you very much for watching.